In this video, I'm going to share with you 8 personal finance lessons that have completely changed the way I think about money, investing, and financial freedom. My intention is for you to apply these lessons to save you years of stress and costly mistakes. So let's dive right in. Lesson number 1 is that wealth is built on behavior, not on income. I used to think that income was the only thing that mattered. In fact, when I graduated college after majoring in finance, I started my career in one of the most lucrative careers anyone could choose out of college, and that was investment banking. And let me tell you, as a financial analyst at an investment bank, I made more money than 99% of people my age. But what I didn't recognize is that the behavior that I used with that income is what determined the quality of wealth that I had. In fact, when I was younger, what I found was I was making so much money and I was very young. I didn't have the right emotional and mental stability at the time. I was wasting it on meaningless things that I thought were important to me when in fact they weren't at all. And so just know that no matter where you are, whether you're starting out your career or you're retired right now, the current snapshot of your personal finance and your wealth is based on your behavior, not on your income. So yes, you do want to dedicate yourself to developing the skills to grow your income. But if all you do is grow your income and everything else rises along with it, then you're not going to actually generate true wealth. So wealth is a behavior. One of the best books that I ever read about this was a book called The Psychology of Money by Morgan Housel. If you haven't read it, I highly encourage you to go pick up the audio book or get the physical book and give that book a read, because it'll completely change the way you view money and help you realize that this is behavioral finance, not just finance. So that's lesson number 1. Lesson number 2 is that time in the market beats timing the market. Now, this has become a cliche today, but it's so true. Now, this is much easier said than done, because what this means is if all you did was put your income into the savings into the market today and let it compound month after month, year after year, decade after decade, you would become wildly wealthy. But the problem is this 24/7 news media stream that we have, not just from mainstream media, but from social media and from podcasts and from our network. All we do is get inundated with stories of the world falling apart, with catastrophes about to happen that are going to wipe out your wealth. And then what we do is we go, now's not a good time to be in the market. I should sell. Or maybe I shouldn't invest in this week or this month. I should wait until that geopolitical thing gets worked out, and then next month or next quarter I'll invest. And what happens when you do that is you miss the power of compounding. There's a reason why Warren Buffett and Charlie Munger beat their drum of the importance of compound interest for so many years. And let me tell you just a personal story about this, because when I started my career, I started my career in 2007. And if you know anything about 2007, it was the peak of the market right before the global financial crash. And in 2008, that's when Bear Stearns went under. That's when Lehman Brothers went under. That's when Morgan Stanley went under. And it was an absolute disaster. Now, what happened is as a 23, 24-year-old at the time, it shaped the way that I view investing. And it created a huge avoidance of risk to where I stayed out of the market for many, many years beyond that. And this was a huge, irreversible mistake, because even though the market is volatile and it went down, had I rode that down, stayed in it, and rode it back up, I would have been far wealthier today. So don't try to time the market. Dollar cost average in over time, and recognize that time in the market always beats timing the market. Okay. And again, these are just my own personal lessons. This is not advice that you should follow. This is me sharing what I did and what I've learned. Okay. Lesson number 3 is that your savings rate is your freedom rate. The gap between your income and your expenses, and how much of that what are you doing and how much time are you taking towards widening that gap over time? You want to widen that gap. You want to make sure that you keep your expenses as low as possible and your income as high as possible. And the problem is that as people's income increase, and this is a lesson that I'll share in a moment, their expenses often increase as well. And so it doesn't matter how much money you're making if you're not saving anything. So be very aware of your cost of living. Be very aware of lifestyle creep, because that's a very common thing and trap to fall into. And in fact, that leads to my fourth personal finance lesson, and that is avoid lifestyle creep at all costs. Again, this is much easier said than done, especially as you get older. Because as you get older and you get married or you start a family, and then you start seeing, parents who have kids that are friends with your kid, and then you recognize the houses that they live in and the cars that they drive. We live in this society, especially here in America, of keeping up with the Joneses. And we're inundated from all the big corporate companies to buy more stuff, to consume. And although that's beneficial to the stock market because it increases the value of these companies, it is not beneficial to your own net worth. And so instead, what you want to recognize is, yes, continue to develop the skills to grow your income and continue to maintain a frugal standard of living. I don't mean cheap, I mean frugal, right? Be selective on where you're putting those resources. I'm not against investing in things that you're very passionate about or spending money on things that you're very passionate about. Golf is one of my biggest hobbies. I love it. I don't shy away at spending a lot of money on a tee time at a nice golf course or going on a golf trip or buying a new piece of equipment. I enjoy those things. But there's other areas that I'm very, very disciplined to keep our expenses low. And I would encourage you to look at the different areas of your life and say, what are the areas that you feel comfortable spending in, and what are the areas that just don't bring you much value and aren't that important to you? And keeping that cost of living lower is going to reduce a lot of the financial scarcity or stress that you may have. My fifth personal finance lesson is to invest in assets, not appearances. Again, this is related to keeping up with the Joneses. But if instead of you going to buy that new car because your neighbor did or your friend did, if instead you were to invest in a piece of real estate or into an index fund or into crypto or into whatever investment asset you deem worthy, and you were to start to receive income or dividends or appreciation from those things, your quality of life, your wealth would grow. And if you do this enough and you have enough assets, you start living off the income and the passive income of your assets. So I don't imagine that I'm going to retire one day because I love what I do, but I want to be able to retire. And the way that I can do that is to grow enough assets in my life to comfortably live off the interest and the dividends. And when I do that, and I have that cover my lifestyle expenses, I am truly financially, I would say, independent. Not financially free yet, but financially independent. And so that's the idea, is investing in assets, not in appearances. The sixth personal finance lesson that I've learned is volatility is a price of admission. This speaks specifically to investing in the stock market, in equities. And I, at a very early age, was risk averse, as I shared, because I started my career right as the global financial crisis happened. And so I stayed out of the market for way, way too long because I didn't like seeing these 5%, 10%, 20% corrections. And as a result, I miss a lot of appreciation because I kept my money on the sidelines. I kept it in very conservative investments like cash, which is eroded through inflation, and bonds instead of equities. And so if you want to appreciate and grow your wealth, you've got to recognize that volatility is just part of the journey. It's going to go up and it's going to go down. And today it swings up and down even more severely than it ever has in the past because we have this 24/7 news cycle that we cannot disconnect from. Unless you're maybe camping and you don't have service out in the forest it's very unlikely that you're not going to hear the latest geopolitical issue or the latest company collapsing or the latest risk in a particular industry. And that creates fear. And one of the worst things to do is to act on fear when it comes to investing. So just recognize that volatility is normal. In fact, when the market goes down, I don't get scared anymore. I get excited. Because if I see a 10% or a 20% correction or a crash, you better believe that any money that I do have on the sidelines, I'm going to get into that market right then and there. Not because I kept it off the sidelines, but because maybe I, had a big payout from my company at the time or anything like that. So that's the 6th personal finance lesson. There's 2 more. The 7th is clarity reduces financial anxiety. I have a personality that can run anxious, and I've worked a lot on this through coaches and through therapy, but I still have patterns that lead to financial scarcity. And the moments when I feel less scarce and more confident is when I have crystal clear clarity. Because if you know exactly what your net worth is, what's your savings rate, what's your cost of living, whether you're in line, above, or below your budget. When you know with certainty around those things, you're going to find that there's less uncertainty, there's less unknown, and as a result, there's less scarcity. You're going to act more abundantly. So yes, although I'm a big believer in reading great books and listening to podcasts and watching YouTube videos on strategies for investing, the inner game is even more important, I would argue. And so really recognize that and learning, okay, what can you do to get a better, clear picture on your financial life right now? Because with that clarity, you're going to feel more confident. Now, my 8th and final personal finance lesson is financial freedom is psychological first. As I said before, yes, I'm a big believer in studying investment strategies. I love doing it. And if you look at the books on my bookshelf over here, there's a lot of great investing books. But the ones that had the most significant and profound impact in my life were not about strategy. They were not about tactics. They were not about what index fund to enter into or whether to do private equity or private credit or real estate or precious metals or crypto. It was about working on what's called behavioral finance. Behavioral finance. Why do we do what we do with money? And if you take the time to do an honest assessment on where your beliefs came from, where your values came from, some of them you created, but many of them were passed down from our parents or our guardians or those who raised us. And in fact, I run the same patterns that I can recognize to this day that my father and my mother ran. And so it's really critical for you to put in the time and the effort to do that, because when you have more clarity, not just on your assets and your liabilities, but your own inner workings, your beliefs, your values, your behaviors, your patterns, you're going to be in more control and you're going to be able to make better decisions. And so that is probably the most important lesson I can leave you with. Do not neglect or ignore the 7 previous lessons, but that one is going to move the needle the most. So if you got value from this video and you want me to create more content like this, because I don't really talk about investing on this channel, I talk about how to grow a coaching business. But if you want more personal finance and investing topics from me, then just leave me a comment below and let me know. This is one of my biggest hobbies, one of my greatest passions. Yes, I sound probably very nerdy when I say this, but it's true. I have studied and been a student of investing and wealth creation and money for a very long time. And in fact, I was very blessed to have certain family members support me in developing this passion. In fact, I just want to share one quick story of where this came from, because this is really, really powerful. When I was, I think, 16 years old, I was working since I was about 12. I think my first job ever, I got a job at a horse farm across the street from my house in Connecticut. And I shoveled horse crap, and baled hay for 40 hours a week for $2.50 an hour. I was paid under the table, so I got cash. So I'd work 40 hours a week and I'd get a $100 bill at the end of the week. This is really funny. This sounds like my grandfather telling stories of when he walked both ways uphill in the snow without shoes. But True story. $2.50 an hour was my first job. But when I turned 16, my grandfather sat me down. He said, "Hey, Peter, I'm going to open up what's called a Roth IRA for you, a retirement account." And I had no idea what that was. But the way that he got me interested in investing was he incentivized me. He said, if you decide, even though you're only 16 and you probably want to spend your money on candy and basketball cards, if you invest a certain amount each month from your paycheck into this Roth IRA, I will match the amount. And so he showed me that that was almost like free money, right? And I discovered that. So I said, okay, if I'm making $100 a week and I'm making $400 a month, then if I put $50 in this, I'm saving a little bit over 10%, but he's putting $50 in this. So I'm actually putting in $100. So I'm actually doubling my money by doing this. He created this interest and this passion for investing. I didn't know it at the time of being a 16-year-old, but I look back now so grateful for that one thing that he did, because it created this habit of moving through needing short-term gratification and instead investing for the future. So I share all that to just say this is something that I'm sincerely passionate about. I would love to share more with you about this topic if you find it interesting. And if not, let me know in the comments as well. Last thing I want to ask you for is that I know the majority of you watching this are not yet subscribed to the channel. So if you're not, please do subscribe to the channel. That way you never miss a future video. And if you do want to learn from me on the how to start and grow a successful coaching business, then definitely check out my next training up here on how to start a coaching business. My name is Peter Scott, reminding you to be here, act now, and fear less.